It is the start of a new month, of a new quarter, and of a new season for the European energy markets. And what first looked like a firm breakout below a lot of support levels has now petered out into nothingness. So, where are we going from here? Hello, my name is Marcello Colax. I'm the managing director at Clever Markets. And today I'm going to walk you through the European energy charts for the week starting 6th of October 2025. As always, everything you see here today is just my personal opinions and, of course, not trading advice and also not an invitation to trading. So, this is what we are starting out this week. It is the sentiment poll for the TTF front month product. And as you can see here, it hasn't really changed from one week to another. So this Monday, still the bulls are showing up with 48% of the votes for the week starting 6th of October, which is nearly unchanged from last week. Same with the bears, the neutrals, and those that have no opinion at the moment. It is essentially a copy from from 2 weeks ago. Now, the markets haven't really pulled through with the bullishness last week. So let's have a look at the charts in just a second to see what is actually likely to happen or what not. So this is the markets that we are looking at today. We have here the TTF front month, the NBP front month, the TTF front season, and the NBP front season. We have European, no, what is this? EUAs, we have German power, we have the Henry Hub and Brent. As you can see, like most of these markets, after like a really strong downtrend that we've observed for quite some time, we have then in late August started to move sideways for most of these markets. As you can see, with the seasons, we did get these strong gaps because we are not looking at the outright product right now, which is something we probably should do, and that's something I recommend you do as well. So our charts will be adjusted very shortly. Now, usually what we are seeing over the past couple of years, since I want to say 2022, 2023, is that the monthly contracts have been stitching up really nicely without any sort of like calculations or adjustments. The months were really smoothly attached. This was a deviation from, I mean, I've been in the energy industry for around a decade now, more than that. And I remember when I started, the gaps between the different months were like large, even for the TTF front month. They have disappeared into nothingness. So that's why we started to work with the rolling front month product. So however, now it seems that we are getting a little bit more of a confused market if we don't, or confused chart if we don't really adjust it. So here, once again, I do recommend that you go to the active front month or that you just look at the outright November product right now or December, whatever you're interested in. So also this explains the season. So this is not due to strong interest in either way. It's really just the rollover gap. Okay, so let's have a look at the TTF front month first. So let's have a look at the weekly chart. Here, once again, nothing really happening for yet another week. So if you're looking at the grand scheme of things, yeah, okay, so the market has been pushing sideways after coming off in February 2025. We had a downtrend identified with this flow of, let me show this to you, with lower peaks and lower troughs. But you can see since June, nothing has really happened. So there's no good big momentum trades available at the moment on the weekly chart. Now let's have a look at the daily chart. Here it is a little bit more interesting. Before I go into the details, I just want to remind you of one thing that you're probably already aware of. So in line with the Clever Markets methodology, we are always switching between two strategies, between a mean reverting strategy and a trend following strategy. So in the mean reverting strategy, we are moving within a tight or clearly defined range. In this case, it would be this descending triangle. If you have seen something else, some of you I know are also working with a symmetrical triangle here that broke lower at some point. We are working with a descending triangle because we had some really good hits here once, twice, three times. Either way works fine, all are good. But here we are working with a mean reverting strategy. And the go-to rule of thumb is if you start spotting a range, don't trade it on the daily chart, go into the hourly chart because here what looks like a tiny range on the daily chart actually looks like manageable swings on the hourly chart because you can see like trading these swings is much better and more predictable than trying to guess is the color of the next candle on the daily chart. Because you can see, right, you have just two red candles and then a green and red and a green and red and two red candles. So this is not tradable on the daily chart at all. So that's why for the past couple of weeks and months since September, we've been more interested in the hourly chart. Now, however, you can see we did break lower. So that means that we are now considering, it's not confirmed yet, but we are now considering to switch towards a trend following strategy or to a momentum strategy, however you want to call this. And this simply means the market isn't going sideways, the market is going up or down. Here, we are looking at tools like trend tools and momentum tools. We are looking at trend lines and channels as we have it here, right? So we are switching away from looking at oscillators as we would have done it on with the mean reverting strategy. Okay, so now here's the thing. How do we know that this here has actually broken lower? Well, in line with the Clever Markets methodology, there's two things or like a few things we can look at. First of all, I want to see two consecutive closes past the key level to confirm that we have really broken lower. And that happened, right? We got one close and here the second close. Now, here's a caveat. If one of the two consecutive closes past the key level turns out to be a reversal candle pattern, as it is the case here, that's a hammer or potential hammer, then this breakout is not as confirmed. And that's exactly what's happening here, right? So now the next step is trying to guess if this bullish setup, this tentative bullish setup, is actually leading to a bounce, or if this potentially bullish setup with the hammer candle will be ignored and the market continues lower. So you can see that we are still bearish inclined overall, even if this corrective move here is playing out for a couple more days on the daily chart or on the hourly chart, right, at the start of this week. Ultimately, we are still bearish inclined. So what brought us to this decision? Well, let's have a look at this potential hammer. First things first, let's mark out the high and the low of the pattern. If we would get a daily close above 31.58, which is the high of this pattern, also this retest level, right? It's an old support. After it has been broken, is now turning into the resistance. So this is like a good measurement to see if, hey, if this holds, then the bears are more likely to continue and this bullish setup is invalidated. But if we get a close higher, then probably we could first make it towards this channel boundary, which is also this descending triangle boundary. And I'm not putting it on right now. It's also from this FIB retracement here. If we put a 0 up here and the 100 up there, this would be near the 61.8% FIB retracement right here. Pretty cool, right? Not happening right now. What else are we looking at? Well, let's have a look. For this, we want to go towards the tools. This pattern here is more likely to work out, this hammer pattern, if we get high volume. So did we get high volume in that? Yeah, we actually did. It was like slightly above average, but please be reminded it is just what was this? The 1st of October. So the market is still taking its sweet time to digest the new information, to get acquainted to the new month and the quarter and the season. So that's why high volume, I don't really see it as a strong indication here, but it is there. Okay, so the next thing I want to see is I want to see a bullish oscillator signal. We kinda got one here, but not really. So what is a bullish oscillator signal? A bullish oscillator signal is if the tool moves into oversold territory. This, by the way, is not a signal. It means nothing. It simply means we are making new lows. The bullish signal would be given if we move out of the level, because that would mean that we are no longer making lower lows. So here you can see we didn't even move into oversold territory. So no no bullish signal generated here. But hey, we can still, like a rule of thumb thing, we did get a crossover a little bit. It's like one of those here and one of those here and one of those here, right? So it's not full on bullish, but okay, why not? Then the next thing I want to look at is the trend and the momentum tools. So here we can see on the MACD that we are making new troughs, right? So this MACD line crossed below its signal line. We are below zero, so it's like double bearish essentially. We are making a flow. We do have a flow of lower lows and lower highs. Also, look at the trend tools. I look at the 8 and 12 exponential moving averages, and here we simply see that these are still pointing lower. So even if we get a little bit of a bounce, the market is more likely to continue lower overall, simply because trend and momentum tools are firmly aligned with the bear trend. Pretty cool, right? So this is how we also identify if any up leg, if it was to happen, I don't think it will, but if it was to happen, if it is a correction in an underlying downtrend, or if it is a full-on trend reversal. Well, with bearish trend and momentum tools, it's more likely to be just a corrective move. Okay, so overall, we are still bearish inclined. Nothing has been triggered yet. This here is very tentative, and the bulls are obviously not pulling through, and they haven't pulled through within two follow-up candles. So that's why, downside continuation seems more likely. Then the next question is, okay, so how low can this market go? Well, luckily, the descending triangle, it's giving us targets, and they are calculated by measuring the length of this pattern, and then we apply this length to the breakout direction. So let me move this around a little bit. There you go. So here the downside target is near, well, let's call this 30, right? 29.87. So this is the minimum downside target that we are expecting if the market remains below the descending triangle, if the downside momentum can be maintained. That's pretty cool, right? So if you are a speculative trader, you might be inclined to open short positions on the hourly chart. And if you are a physical trader, then maybe now is the time for you to like wait it out maybe a little bit if you have time, and try to get some good volume as we are moving lower, and then maybe just keep an eye on the hourly chart to see when the market is bottoming out to grab some cheap volume. Now let's have a look at the hourly chart. Remember, on the daily chart we have a descending triangle, and on the hourly chart we have an ascending triangle. So, and ascending triangles are usually resolved to the upside, and descending triangles are usually resolved to the downside. Now, this still makes perfect sense because it is showing us that the bulls are willing to buy at higher and higher prices for now, while the market is steady with the selling levels. So ultimately, this should push the price higher at least a little bit. But you can see, even if we get a marginal upside resolution, which we think could happen, the bears are still overall more likely to continue. And you can see we are working with these FIB retracements here, right? You can see this is the initial down leg, 0 down here, 100 up there. The 61.8% FIB retracement is here, which somewhat coincides with the ascending triangle boundary. So we think, yeah, maybe a little bit higher, but this whole thing is unlikely to play out. We didn't, so why is that? So first of all, we do think that a little bit more strength is possible. We are probably moving above the MACD's zero line, which would generate a bullish target. But hey, look at this. We started seeing lower peaks, and we started to see lower troughs. So that means that ultimately the bears are still more likely to push through, even if we get a marginal upside correction. And you can see how you can see the interplay between price moves and the moving averages and not Ichimoku clouds, MACD, and all the other tools that we are looking at to assess how likely the market is to pull through. So here we see on the stochastic, so of course our oscillator of choice is the slow stochastic. We do see a flow of higher highs and higher lows, but so there is a little bit more room to grow. But now imagine that the market is moving into overbought territory. We don't believe that it will remain here for long, and as soon as we start breaking below 80, that would then be a signal for us for the market to reverse lower overall. Okay, so now this is what we are dealing with on the TTF front month.